Hello and welcome. Thank you for joining us in this webinar. I'm Nicole Aubrey, the Head of Distribution at Associate Global Partners. Today, we have the pleasure of speaking to Ryan Quinn, Client Portfolio Manager at WCM Investment Management, to discuss the WCM Quality Global Growth Equity Strategy. But before we begin, some brief housekeeping and a message from our compliance team. This webinar is for educational purposes and of general nature only. It does not constitute personal advice, it must not be acted on or relied upon, and this webinar is not an offer, recommendation, or solicitation. Throughout the session, we'd love to hear from you, so if you have any questions, please submit them via the question box in the control panel on your screen. Ryan, lovely to see you. Thank you for your time today.
Great to be here, Nicole.
So let's jump right in. For those people who might be joining us for the first time today, can you, Ryan, give us a quick overview of WCM Investment Management, please?
Sure. WCM is an independent investment firm located here in Laguna Beach, California, managing about 120 billion US dollars in global equities. Our portfolios are high conviction. We seek to outperform benchmarks, investing in quality growth businesses in every market across the world.
Fantastic. And for those unfamiliar, can you tell us what's particularly unique about the WCM investment process?
Sure. We love to invest in high quality businesses with growing competitive advantages at attractive valuations. But that's not very interesting because everyone says that. Really, what makes us different in terms of how we approach our approach on how to do that is twofold. First is our view on competitive advantages, and second is our view on corporate culture. In order for us in our fundamental work to get excited about a business or to buy one for the portfolio, we need to be able to make the case that the competitive advantage of the company is growing. So if you imagine an economic moat, it's not enough just to have a moat that defends the asset. That moat has to be consistently growing over time, and we try to identify the drivers of that moat to make sure our investment thesis is healthy over time. The second piece of the puzzle, corporate culture, is a little more warm and fuzzy. It's difficult for people to nail down. We don't put a numerical score, a color score, or any other sort of a moniker to it. It's purely a framework that we will use to understand what animates employees at a business. We want to see a corporate culture that is aligned with the competitive advantage because the corporate culture will define employee behavior. Employee behavior will define business outcomes. Secondly, we want to see that culture is widely held or that it's strong across the entire business. And then thirdly, we want to see a culture that's adaptable. We're investing in businesses for the long term. We take a 5+ year time horizon on our investments. And over that time, the business is inevitably going to face internal threats as well as external threats to their growth. And so having an adaptable culture will allow the business to thrive regardless of what comes at them in the marketplace.
Excellent. That does sound very unique. And now I'd like to take a quick look at the quarter that was. Can you share your observations on global markets recently and maybe go into what the key drivers and how favorable or otherwise it has been for growth style investing?
Sure. So global markets were generally positive in the third quarter of this year. They've been positive year to date, despite a number of different influences that have potentially led to some slowing growth. But markets have really trudged along higher. These influences would include decisions by the U.S. Federal Reserve on rate levels, the softening of the labor market, persistent inflation. These are things that have sort of been consistent throughout this year, quarter over quarter, and the third quarter was no different. Some positives that we've seen is corporate earnings remain strong. Consumer spending is stabilized, and there's very broad optimism driven by AI that's creating a tailwind for not just the tech sector but other industries as well. Within WCM specifically, the drivers of performance have really been through stock selection. The Quality Global Growth portfolio is a concentrated portfolio, 35 to 40 stocks. Today is 37. And the individual theses, the individual stocks we own have been the main driver of performance, not just in the third quarter, but really over the long term for this fund. Specifically in the third quarter, tech and industrial sector holdings really performed best. And then overall, our exposure to themes like automation, digital infrastructure, global supply chain shifts, aerospace, defense, and kind of the electrical grid have been winners for us in the most recent term.
Fantastic. Thanks, Ryan. And it was another quarter in which the WCM Quality Global Growth Strategy outperformed the market. From an attribution perspective, what were the main contributors to this performance?
The main contributors have been ones that we have really pivoted to or embraced in the portfolio coming out of what was a volatile year in 2022. So, in addition to areas like aerospace and defense, we've been investing in some businesses that are experiencing profit inflections due to some under the hood changes that the company has made, led by unique leadership. We've also seen businesses that are performing very well in the area of AI that is creating bottlenecks within that supply chain or within that value chain, really. And probably the most consistent returning sectors or themes have really been in that aerospace, defense, and electrification and or the grid. But healthcare, on the flip side, has been one that has been challenging for most of the year.
Excellent. And have there been any major changes to the portfolio during the quarter?
I mentioned the AI kind of value chain and bottlenecks. We added two companies that we'll be disclosing throughout this quarter. One being a high capacity disk drive business, and the other being a fiber optic cable business. Um, as many of you on the webinar know, we tend to invest in picks and shovels plays against themes. So rather than trying to pick a individual winner where all others will lose, we try to pick businesses that are going to have a tailwind that is created by a broad theme. In this case, artificial intelligence. The amount of memory that's going to be needed for the advancement of AI, the piping that's necessary to transfer this data, will both put consistent and high demand in these high capacity disk drives as well as fiber optic cables. On the other side, we've reduced our exposure to a few niche U.S. based consumer names, as well as a individual Chinese food delivery business.
Excellent. And there were two fairly iconic brands that have been added to the portfolio recently, being Nintendo and Rolls-Royce. Can you take us through the investment thesis and how the moat trajectory and aligned corporate culture helped make those purchases appealing?
Sure. Starting with Nintendo, this is a business that we looked at for a very long time, and we noticed a shift in the business that got us very excited. Nintendo is a vertically integrated Japanese gaming company known for both its hardware consoles and its software content. Really, the crux or I guess the basis of its moat is going to be on its intellectual property. Think of Super Mario, the Legends of Zelda, Pokemon, those types of IP assets. But it also has the vertical integrated hardware system that embraces their own software business model. What's different right now is there's been a bit of a culture shift at Nintendo. The prior consoles had been ones that would expire as a new console comes out. This product cycle, we're looking at the Switch 2 that has been released earlier this summer, which is the first Switch to come out in, I think, over 8 years since the original came out. The main differences being, in addition to obviously better graphics, better user interface, better user experience, this Switch 2 enables third-party games to be onto the platform. Historically, Nintendo has been very protective over their IP. They don't let outside game producers to come into their environment. However, that has changed, and so we think that there's going to be a significant upturn in the use of the Switch 2, the integration of third-party games, which will then inevitably lead to greater in-application spend by their users. So they'll be able to further monetize their users in a more significant way because they've got a broader set of offerings. And this is really all coming about to an improved culture alignment, and which has strengthened our thesis. The other kind of newer holding, or one of our favorite new holdings is Rolls-Royce. We identified aerospace. I've mentioned it a few times already as an area of the market that had under-earned its pre-COVID growth rate. And this is a business that many will equate with the iconic cars, luxury vehicles, but they really don't make them anymore. The bet on Rolls-Royce today is really a business that has four main drivers. They've got an aerospace division. It's about 50% of their revenues. They make power systems across marine and other vehicles, and they have a defense portion of their business as well. But really, we focus on this aerospace side. They have the majority of the engines on the wide body airplanes. We're seeing an interesting characteristic in the aerospace industry where commercial airlines are requiring engines to be under wing for longer, which means that not only will Rolls-Royce benefit from being the dominant seller of those engines to these commercial airlines, but also they will benefit from long-term maintenance contracts that will provide consistent and recurring revenue over time. This is a bit of a culture turnaround as well, as the current management team came in about 4 years ago. In 2020, during COVID, the business was crushed, lost earnings and revenue, and the current management team has done a phenomenal job streamlining the business, getting very close to their customers, and having a real focus on getting these maintenance contracts written correctly. Because, as I mentioned, they are going to be extended compared to other cycles for the aerospace division, and we expect that to be a very strong driver of margins.
Excellent. Thanks, Ryan. And we've spoken a little bit about AI earlier today. More broadly in the market, there's been a lot of discussion about AI and the potential of a bubble or a potential bubble in AI related stocks. How exposed is the portfolio to this theme? And can you give us a couple more stock examples?
Sure. I mean, yeah, we'd agree that, you know, if you say your company has something related to AI, your stock's probably going to go up, right? There's quite a few probably lower quality businesses out there that are benefiting from having AI somewhere said inside their name or inside their business target. The way we approach, and I mentioned the picks and shovels play, is really kind of from multiple angles for artificial intelligence. We think we've diversified into a few different angles that are going to help us not only win as AI is a rising tide, but they should protect us from any sort of bubbles bursting when these lower quality businesses are exposed as not really being real contributors or beneficiaries of the AI trend. Obviously, we've owned Nvidia for a number of years now, and that's really been the driver of large language models, which is kind of the most obvious piece that we own. That's in the hardware space. I mentioned those two new purchases in the disk drives and the fiber optic cables. That would also be a hardware exposure. And then it's important to understand that electricity and the grid are going to also behave more like these tech companies that are exposed to AI because it's a brand new demand driver for energy and for things like gas turbines, wind turbines, et cetera. So owning companies like Siemens Energy, as well as GE Vernova will play not only that electrification theme and the grid upgrade, but it's also going to benefit from AI tailwinds. So we would include that in the category of our AI exposure. And then, of course, we own Taiwan Semiconductor, which will be the dominant foundry, producing all the chips that will be going into anything related AI, whether it's servers or computers or anything else. So overall, those names you can approximate around 15 to 17% of the portfolio, but hopefully people are feeling like it's not a one-way trade. It's got multiple ways to win and that we're diversified across a number of different high quality companies.
Fantastic. Thank you. And so we've talked a little bit about AI. We've talked a little bit about aerospace. What are some of the other thematics that you're positive on at the moment that you've got exposure to in the portfolio?
I mentioned some of the businesses that are inflecting from a profitability perspective. Nintendo would certainly fall into that category. We want to be exposed to the consumer to some degree. We've got some e-commerce names that we like quite a bit and have in the past. Mercado Libre, businesses like that. And then in the financial sector, we continue to like the insurance industry to some degree, reinsurance exposure, as well as some of the trading platforms like Robinhood. Healthcare, as I mentioned, has been a challenge for us and has been de-emphasized to some degree, but we sort of feel like that area of the market is getting into the late stages of pain. So I wouldn't be surprised if we found the next time we speak, some of the most exciting opportunities could be in the healthcare space, but we're just not really there just yet.
Being a concentrated portfolio, sometimes you have to make the tough decisions and look at what's in the portfolio and say, where can we trim to make way for this new great idea that we have had? Where are some examples that has happened in the portfolio over recent times?
Yeah, so in general, a position can get into the portfolio or out of the portfolio based on our two core tenets, that moat trajectory and corporate culture. And so anytime a business, as an example, has their moat trajectory impaired, it becomes a sell candidate. It becomes either a source of funds or an immediate sell. There have been some influences in the marketplace this year that have, and prior to the year beginning, that have impeded some moats on some of the businesses that we have owned. Thinking of a company like Floor and Decor here in the U.S., they're a flooring business that sells both commercially and residentially. They were at risk to the tariff increases. When we look at IT consulting, currently IT consulting is being threatened by AI, but earlier this year, we had sold out of Booz Allen Hamilton, which is the leading IT consultant that enables the United States government to upgrade their technologies. We were in a period of the shrinking of government when Doge was really going after different government programs to make sure that things were lean and right sized as we tried to combat our deficit. And so it seemed that Booz Allen Hamilton had an unclear future at best, and at worst, their moat trajectory was really impaired. So we exited that position. Again, another tariff related sale would have been in Thermo Fisher Scientific. This is the world's kind of largest and most diversified life science tools company. They manufacture these tools all over the world. And while they are necessary, some call them the Amazon.com of the hospital to literally produce everything that goes in and out of those doors. They were at risk of a slowdown in purchases coming from hospitals, but also increased pricing due to these increased tariffs. So we exited that position. All in all, it comes down to when we're looking at the 40 best ideas in the world, it doesn't take very much to make one thing less attractive than another. So we always have very steep competition on the sidelines of businesses we don't own, but we follow very closely. So it just can take one of these small factors to influence our sale. If not, it could be a trim just to make room for another name. But in these three cases, that those were sold and used as sources of funds for businesses that really didn't have those moat trajectory headwinds or geopolitical or macro pressures on the thesis.
Yeah, that makes a lot of sense. And then, so from a valuation perspective, what are the metrics of the portfolio now in terms of PE multiples or price earning multiples compared to, say, 6 or 12 months ago?
Yeah, I'll do you one better. The next 12-month PE on the portfolio is around 24 times. It's maintained that around that level. I think it's been somewhere between 22 and 24 since about 2023, and yet our performance has been good. I'll just say that. I'll let others judge. What that tells us is that our businesses are growing their share through earnings expansion, right? So it's a very healthy way for the portfolio to be growing. We're not growing through multiple expansions. They're not getting more expensive. We're not paying higher multiples for dollars earned in the companies. And in fact, I believe the long term since inception, going back to 2008 here in the U.S., multiple average is around 23 times. So we're just above long-term average with a very unique portfolio exposed to 37 stocks, but a very broad range of themes and individual quality companies.
Excellent. Thank you. That's very helpful. And so if we now turn to outlook for markets and for the WCM Quality Global Growth Strategy, where do you think we're heading? What does your crystal ball say, Ryan?
Oh, Nicole, you know us better. We do not have a crystal ball, and we are very, probably annoyingly consistent saying we don't make a lot of predictions. With that said, I think looking backward, we learned after 2022 that really making sure that our holdings are uncorrelated, making sure we've got a diversified set of exposures to a number of different themes is going to really matter. We think our corporate culture work will while it has been additive and excellent for us in the backward looking period, in the coming 5 or 10 years, we think that muscle is going to be extremely important, helping us make quantitative decisions off of qualitative information. So certainly, I can guarantee one thing: there'll be market factors and drivers that we never could have predicted that will be moving markets. But the obvious things to pay attention to are, how are labor markets doing? What's happening with inflation? How are economies responding to, broadly lowering interest rates? Are we, are we on track to recovery, or are we threatening to go into recession? So those are things we'll keep our eyes on. We won't make any predictions. But it is a benefit or a luxury of having a concentrated portfolio, because we don't have 100 names in the portfolio that we have to understand all of the exposures to. We simply find the best 40 ideas in the world and make our investments based on individual theses. As news comes up and as those unknowns uh, make themselves known, then we can look at each individual company and make a decision on where our conviction lies. Is the thesis strengthened, weakened, broken? Any one of those things can happen, but at least we can do it in a very concentrated way, and potentially minimize damage if markets do go down, but also profit when things do turn positive, more broadly positive or strongly positive.
Excellent. Thank you, Ryan. That was really insightful. And I'm sure everyone's got a lot of new information about the WCM Quality Global Growth Fund. And thank you, everyone, for joining us today. If you have any questions that we didn't get to, then a member of our sales team will follow up directly with you after this session. And if you have any questions about the strategy, please contact us by calling 1300 052 054 or emailing us at invest@associateglobal.com. Thanks again and have a wonderful day.
Thanks, Nicole.